So, hello and welcome to this week's instalment of Nucleus Investment Insights. And we've entitled this one, Housing Bust Ending. So there's been a little bit of a resurgence in mainstream media of some green shoots, perhaps signs of life that the housing bust is perhaps drawing to a close. So we thought it a great time to revisit a almost perennial topic on the Investment Insights podcast and run through some data updates and give everybody our point of view. I'm joined today by a full table actually, and I have going around in no particular order our Chief Strategist David Llewellyn Smith. Welcome, David.
Hi, Tim.
We've got our Chief Economist Leith van Onselen. Haven't been on the show for a while, Leith, so welcome back.
G'day, Tim.
And of course our Head of Investments Damien Klassen. G'day, Damien.
Hi, Tim.
Very good. So we'll jump into it. So as mentioned, it's we're going to be coming from a reasonably data-driven viewpoint as always, and what you'd expect from the MB team. And we're going to be looking at some things like declines from peak, finance and dwelling growth, city sales and price growth, construction and population change, and finishing up on dwelling approvals, and of course plenty of opinion and insight along the way. And as always, we'll finish off with implications for investment on how we run money every day here at Nucleus Wealth in the MB Fund. So with no further ado, I'll hand over to who'd like to begin. Leith looks pretty chafing at the bit there, so let's get going. Leith, declines from peak overview.
Yeah, so look, there's been, as Tim alluded to, there's been a lot of discussion about Australia's housing bust sort of nearing an end, and we're reaching a bottom. And this view's basically been brought around by a few factors. First of all, the monthly declines have been shrinking. So whereby at the end of last year we had property losses, property declines of about more than 1% per month. They've slowed to about 0.4% in April, and also quarterly declines were running at about nearly 4% at the end of last year, and they're now slowed down to about 2%. So that's got a lot of people in the property media excited that house prices aren't falling as quickly, and they're pointing to a rebound. On top of that, we've had a bit of a jump in auction clearance rates, although they're still running below levels of last year. And of course, there's a whole bunch of talk about interest rate cuts and a whole lot of other things that we'll talk about a bit later. I guess today I want to sort of curb the enthusiasm a bit, because while monthly and quarterly declines have shrunk, a lot of that is actually seasonal. So in the first 4 months of the year, property prices are generally stronger. So a better way to look at it is actually to compare year-on-year declines, and those are actually accelerating still, which means that for example, April 2019 fell at a faster rate than April 2018. That means the annual losses are still rising. We've got Sydney and Melbourne's annual losses are running at double-digit rates, and nationally we've got losses running around 9%. So there isn't a whole lot of evidence that the market, at least in terms of prices, is recovering. And just to kick the old data deluge off, we've included a chart here which basically shows the declines from peak across the major markets. And for those of you watching it live, you'll notice that the declines have actually steepened over recent months. And at the 5-city level, the peak to trough declines so far are running about 10.4%. We're looking at about 11% in Melbourne, nearly 15% in Sydney, and Perth's running up to nearly 19%. And I will add that this is actually the deepest bust and the second longest in around 40 years of CoreLogic's data nationally. Sydney's experienced its second longest bust on record, and also the second deepest. Melbourne has experienced the deepest bust on record, and the second longest, and Perth's experiencing both the deepest and longest bust on record, running at around 4.5 years. I guess my key point is that no, there isn't any evidence that the market is turning around if you just look at the data, and that's also confirmed by the next chart.
Before you move to that, can I just give a bit of a leak on some of tomorrow's data that you've already loaded up at MB?
Yeah.
Just to underline the point that you're making about seasonality and prices, we know that Q2 is always a seasonally very weak period, especially May. and CoreLogic have a number of times actually reformed their indices to try and clear up weakness through the Q2 period. And, we've got a couple of weeks now from sort of late April and early May where the bus has already re-accelerated pretty dramatically in the last couple of weeks. Now, obviously, when you're operating on weekly data, it's very noisy, etc. But it's just a nice illustration of your point that seasonality is playing some role.
And also, and adding to Dave's point, the annual losses again rose this week versus the previous week, and they rose previous week versus the week before. So it gets back to this point that there is a lot of seasonality in the data, and in fact, when there isn't actually much price evidence that the market is improving if you take into consideration the seasonality.
Okay, sure thing. We'll jump across to the next one now. So we've got finance versus dwelling growth, so Australian finance commitments versus dwelling price growth. And I didn't mention before, but I will chuck in the link to the slides for those that are listening on the audio as well. So just wait for that one.
Yeah, well, we haven't gone too slide heavy today. There's only about half a dozen, so we'll focus more on the discussion. But what I've put up here is a chart tracking housing finance commitments, the value of housing finance commitments versus dwelling price growth. And the reason why this is probably one of my favourite charts or housing metrics you can use, because there's an incredibly strong correlation between the value of housing finance commitments and dwelling price growth, as you'd expect. And anyone who's watching this live will see that the growth in housing finance commitments remains firmly negative. It's still falling, and alongside that, obviously, the annual growth in dwelling values is also falling. So until we start to see housing finance commitments start to pick up, it's unlikely that house prices will in fact bottom.
Okay, sure thing.
And segueing on to the next one, this is a similar sort of chart. We've basically tracked capital city house sales volumes, dwelling sales volumes, that's houses and apartments, versus price growth. And again, there's another incredibly strong correlation here. And
actually, Leith, can we just wind back to that previous one, because it's probably flicked over too quickly, that whole thought behind this finance commitments. Because I guess just for context, there's obviously we've been through this period where credit was incredibly easy to get, and then we've hit the Royal Commission, and the Royal Commission's decided, assessing people at poverty rates to work out whether they can take a loan is not a good thing, and you actually need to assess them at realistic rates. And that sort of flowed into a sharp contraction in credit, which we sort of seen on this graph. But for anyone sort of on the podcast, there's that line pretty much from as the Royal Commission starts is when you start to really go negative. So the concept now is that's bouncing around, and David, you've discussed a few times, is that whether there's pressure on the RBA or APRA, more importantly, I suppose, to loosen up again in terms of in order to let the finance back out. Yeah,
it's the interest rate buffer is what they want to.
Well, that's I think the key discussion for the entire presentation. I wonder, should we just come back to that once we've run through the charts?
Yeah, because there's that and a few other policy things that and interest rates and negative gearing and stuff like that, which probably all factors. I don't know.
Okay, yeah, sure thing, no worries. All right, we'll jump into city sales versus price growth.
Yeah, I won't bore everyone too much longer with charts, because they're actually just about over. So then we can get into the meat and potatoes. So again, we've got capital city sales volumes have tanked to below the levels that we saw in the GFC, and they're running at the lowest level since I think the 90s. And again, there's a very strong correlation between sales volumes and prices. Both are incredibly weak. Just to put some quick numbers around that, Sydney's sales volumes are down 44% from peak, Melbourne's are down 34% from peak, Brisbane's are down 28% from peak, Perth's are down 35% from peak, whereas across the combined capitals, sales volumes are down 31% from peak. So pretty much all a third or more. So they're obviously very, very heavy falls there, which is interestingly, there's an article's come out today about how there's massive losses in the real estate industry. They're looking at 15,000 job losses. Again, the most since the GFC. and that obviously reflects lower commissions from lower sales volumes primarily. We'll skip across to the next one. Now we're shifting away from the actual prices towards the real side, dwelling construction. So for those of you listening, I've got a chart here tracking annual dwelling approvals, commencements, completions against population growth. And while completions and commencements are still running at pretty high levels, they are starting to turn. Whereas the big warning sign for the Australian housing market is that dwelling approvals have crashed. So after peaking at 242,000 in the year to August 2016, they're now down 18%. They've gone below 200,000. If we flick to the next chart.
So in a way though, it's two-edged in terms of this, isn't it? The higher it stays for the longer it stays, then the worse
the oversupply.
The worse the oversupply. But the flip side is the Australian economy is incredibly reliant on the construction jobs, and so if the 9%. Construction jobs aren't there, then and the multiplier effect of those, then your unemployment starts to rise. So it's sort of that it's the flip side of saying, well, it's a sign that the faster the commitments falls away, then the sooner you can expect housing market to stabilise. But the flip side is the faster it falls away, the worse it is for the Australian economy, which means
unemployment. Yeah,
which means the downturn is probably going to be worse. So
it's also a pincer.
It's also interesting to note that the contemporary sort of global expert on bubbles, Jeremy Grantham, always looks for this pattern for the culmination or end of a bubble and an entrance of a bust, as he looks for a massive surge in supply.
Yeah.
As a typical kind of turning point. You can debate whether this one's massive enough, but we've certainly had one.
Yeah, well, I mean, it does look massive when you look at it, although we did obviously have a massive population spike as well. So, but I guess the key point is that, as Damien alluded to, 9% of employment, or just over 9% of Australia's employment's in construction directly, and arguably dwelling construction is the most sensitive to, that there's more people. It's more job intensive, dwelling construction, than say infrastructure construction.
Yep.
And
mining.
Yeah, that's right. It's especially mining, way more than mining. So as the dwelling construction bust gathers steam, and it's it won't really show up hardcore until the latter half of the year and into next year, because dwelling approvals are a leading indicator by many months. But when it does kick in, we're likely to see a big rise in unemployment.
Construction job ads are cratering as we speak. So.
Yep.
Yeah.
Just a quick one. So obviously we've sort of got the life cycle, essentially, approvals, commencements and completions of property there. Units and houses are baked into these figures?
That's right, yeah. So
okay.
I've just combined them. Most of the uplift we've seen over the last 5 years has been in high-rise. I didn't bother putting it in here because I didn't want to complicate it too much. But we saw a massive high-rise construction surge across the three major markets, so Sydney, Melbourne, Brisbane, as well as the ACT. Sydney, Melbourne, Brisbane are all collapsing. The approvals are collapsing. ACT is still up at ridiculous levels, but they don't really move the needle.
Crazy numbers of cranes.
Crazy.
Like there were more cranes in those four cities than all of the US.
Yeah.
Like it was...
And the perverse thing about it is, although the approvals have crashed, we've still got a whole bunch of supply still hitting the market now, and we'll likely to do it in the next 6 months as the completions catch up. So we're still looking at more supply, but further ahead, we're looking at a big job cratering.
And the very, 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 very thin silver lining on that very dark cloud is that the amount of jobs in building high rise is generally less than what you see in building houses. So when you get so if you had had a housing boom where we had built that number of houses, there would have been so much more employment, which would then been lost as well. So that's a very, 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 very thin silver lining on a very dark cloud.
But both segments are falling. It's just that high rises obviously went up much more, and it's now falling much more. Houses are just falling a lot more subtly.
Yeah,
They
okay.
didn't have the big boom.
And just a quick one. Obviously, we've been following with vigour the and I'm speaking more about out my way, where we've got the land issues, the house and land packages that are now starting to really gather pace. Would we expect this? It's almost like a little
so
bit
when
of
you say gather pace,
or the fall's gathering pace, rather. The what would you call the running for the exits? I guess is if you have a look on Gumtree for starters. So is this like a bit of a potential double hit? So we've got perhaps a blow off or a falling down in apartments, and then something, another story, another narrative to play out in these house and land packages. There was a DFA thing that he was talking about. Melbourne as well.
Well, Melbourne lot prices. So that's detached vacant house prices. Exploded by I think 30% in a year.
Yep.
And they've grown to ridiculous levels. Melbourne lot prices were usually about 200,000, and I think they're now close to 400,000. So they went up 30%, I think, in the last year, and the year before that they went up about 20 odd.
Yep.
And they've just experienced ridiculous growth, and it's a massive bubble out there. There's no doubt about it. We've had a lot of recent arrivals into Australia have been speculating quite hard. And
it's sort of a leverage game without the debt behind it in a way, because you stick your $10,000 down,
Yep.
you've booked your thing, and then when it comes up time to pay, and you can, what you're able to do before was to resell that, and okay, I've made 50 grand on my 10,000 investment or whatever, and isn't that great? Let me go do that again and again and again until the day when you wake up and
Yep.
your $10,000 is gone, and plus all the other ones you've.
Yeah.
we saw this in Melbourne in the early 2000s with and probably Sydney as well with the Henry K phenomenon, except it was with more with apartments, where people were buying places without deposits, using deposit bonds, hoping that the prices would go up and then you could sell it for a profit. But unfortunately the tide's gone out and they're all swimming naked.
Very good. Okay.
So lucky last chart. This is basically a play on the previous one, which showed the dwelling construction across Australia. Now, what I've done here is just broken up the monthly trend approvals data across the capital cities. Across the major states, I should say, not the capital cities, but obviously that's very capital city heavy. And what it's shown is that across the nation, monthly trend approvals are down 27% from peak. New South Wales is down 29%, Victoria's down 34%, Queensland's down 49%, WA's approvals are down 51%, and South Australia's down 37%. So pretty much across all the 5 major markets, we've had a big decline in dwelling approvals.
And just remind us what the rough time frame from dwelling approval to.
Depends. If it's a detached house, it's be 6 months to a year. If it's a high-rise apartment, it's more like 2 years.
How about in terms of just getting the shovels? So it's pretty quick though. Like on average, it's 2 or 3 months before they're actually employing people to. Do stuff, or
it also depends on whether or not they actually go from approval to commencement. Like typically,
yes, yeah, that's what I was asking.
Yeah,
sorry, the difference between approvals and commencements.
Typically about 95%, I think the ABS said, of approvals end up being commenced, and
Right.
5% get cancelled. There is obviously the risk now that the bubbles burst, that some of these ones that have been approved won't end up going ahead. I'm just trying to. It's pretty quick. If Tim goes back a chart, you can actually get a pretty good idea where I've plotted approvals and commencements. They're actually they follow about 1 quarter or maximum 2 quarter behind.
So it's blue versus red there.
That's it. Blue versus red.
Yeah.
So we're looking at about
3 months.
3 to 6 months.
Yeah.
Of difference between approval and then commencement. But then there's obviously a pretty big lag between commencement and completion.
Okay. Yeah, sure.
And that's and that time frame has extended since we had the high-rise boom, because that takes longer to build.
To build out. Okay, very good. So, well, on that, I guess we move into headwinds and tailwinds for Melbourne or for Australian property prices.
Yeah, well, I suppose we can go back to Damo's question now. One frame of reference through which we can look at potential house prices is credit availability. As Damo said, the Royal Commission had heavily crimped lending standards. And of course, behind that, we've got the RBA, who has become incredibly recalcitrant about cutting rates. And those and on top of that, of course, we've got APRA's macro-prudential stuff, which some of it is still in play. Some of it came in and went out again on investors. But all of these various factors, I should add as well, we've got fiscal factors to consider, although I guess they'd be separate to credit availability. We'll come back to those. So in terms of RBA and APRA, there's basically a war on how to conduct Australian monetary policy right now. It's being fought between RBA, APRA, ASIC, MB and the AFR largely.
And banks.
And banks, most importantly, the AFR being the banks, more or less. It's really obvious that the RBA is miles behind the curve. There's absolutely no reason for them not to have already cut interest rates. They seem to have unilaterally decided to change their inflation target. Nobody really quite understands why. Maybe they're trying to deflate the housing bubble. Maybe they're not. Nobody knows. But they've narrowed themselves down now to one single data point as their trigger for action, which is the worst one to use, the most lagging indicator in employment. And even that one, UBS had some great research out this morning showing, a rounding error on the unemployment rate could now be the trigger for RBA action.
No.
So I mean, it's just absurd. They've basically dismissed 95% of their data feed to come down to this one point on whether or not they should cut.
And coming back to Leith's point about the 9% of the Australian economy in construction, and that's just direct. Then you get all the
Absolutely.
the ones behind that. There's probably a multiplier of at least another 50%, maybe more.
There's heaps. I mean, there are profit warnings raining down from building suppliers. And then you've got consumption and wealth effects.
If you were running a central bank and you knew there was a particular sector that was coming off steam, and that was your the housing part of your economy is one of the most cyclical parts, and you're going to wait till that halves before you see the effect in the housing market, before you see the effect in the unemployment rate, at which stage the thing's already halved and it's too late to turn that thing around. So you've picked. Not only have you picked, as you said, one of our most lagging indicators, but given it's actually a housing problem and how much of the economy how the economy's jobs are based around that, then you're sort of you've also tied yourself to the fact that, look, this thing will either magically get better and we'll be off and running, or we're going to have a big downturn. There's sort of almost nothing in between.
Basically, and they'll be forced to cut harder and deeper than otherwise later.
And as alluded to by Damo and Dave, it's not just construction. They've got retail, which is I think about 7% of the employment. That's heavily impacted as a wealth effect. We've also got manufacturing. Manufacturing jobs have come off. They rose quite strongly over the previous 2 years. In the last half, they've come off quite strongly. And I don't know the exact reason, but I'm guessing it's because inputs into the housing supply process, like plasterboard, etc., have shrunk. So now manufacturing is shrinking as well.
All the PMIs are indicating falling employment.
Yeah. So I mean, I guess it's probably 25% of the labour market's very exposed to house prices.
Job ads have been falling for well over a year. The RBA has hung everything on ABS job vacancies, which is the complete outlier in all the data. It really is behaving very poorly. Anyway, job losses are coming. The RBA is going to be forced to cut. So, I mean, whenever that happens, I guess when we get our rounding error in employment or unemployment, and it's finally forced to get off its chair, we're going to see a couple of cuts through the second half of the year. There's another complicating factor here, which is APRA. And this is where we come to the war. For one reason or another, the banks have launched a major lobbying push to get APRA to slash some of its macro-prudential lending standards. The main one being this 7.25% interest rate buffer, which is, at the moment when you lend, you've got to assume that the borrower can repay at 7.25%, when in fact, real mortgage rates are around, what are they, 4?
Yeah.
And so everybody's complaining that that's unrealistic and absurd. Of course, you can't look at that in isolation.
And having said that, so the Nucleus, we bang on about interest rates staying low for longer and being in a secular stagnation and things like that. So I guess in terms of we certainly buy the argument that interest rates are going to be much lower for much longer. But I guess it more comes back to the the visual of banks influencing APRA.
Yeah.
2 months after they've been trawled through the Royal Commission for spending all their time being too friendly with APRA and influencing APRA.
And trashing lending standards.
Yeah.
Exactly.
Like in a governance sense, it's absolutely just a terrible optic.
Yep.
Really bad.
Just a quick one, Dave.
But as well, like just in terms of management of monetary policy, like your sort of raw club is the interest rate, and then you refine with macroprudential. It's more when you're turning the knobs to get things right. If you don't want to misallocate credit one way or another, right? So if you want to have an impact, and what we have here is a very swiftly declining and sliding economy chasing a housing bust down. Now you can turn these knobs on macroprudential and it might make some sort of effect and what have you, but what they really are is kind of insurance for you, the way you use the interest rate lever. So whether or not you want certain, as I say, credit to go in certain directions, they're not supposed to be the master control for monetary policy.
Well, more importantly, on exactly that same theme, what it's meant to do is it's meant to make sure that you don't get credit all of a sudden accumulating in one small part of the sector. So you basically go, okay, we've got lots of credit out there. We don't want it all ending up in the housing market when we really want it to be in the businesses.
Yes.
And in the middle of a bust, do you want it sort of going back into first home buyers to go out and leverage themselves up to buy new houses, or do you actually prefer businesses to be out there, other businesses to be out there borrowing to fund expansion?
Productive versus non-productive.
But is that a solution then where, and I don't know if this is in APRA's purview, where rather than trying to restrict, which they're doing, obviously it's working in the housing side, is trying to then open up in the commercial credit side? Is that or is that just an automatic stabiliser of having very low interest rates and being able to borrow cheaply?
You mean, could they turn the knob on commercial lending?
What I'm saying, yeah. So is there a macroprudential?
They could try with fiddling with their Basel 3 stuff and whatever, but there's a bigger problem than that. Is that the banks, are now structurally dependent on house prices to lend to businesses.
Yep.
Right.
Yep.
They've got all their collateral is tied up for business lending in houses because they lost the art of business lending over this bubble.
Yep.
And you can see the government's trying to fix that through various funds and whatever, but they're all way too small to make any material difference.
And a lot of that's because it's easy. The small businessman turns up and says, I'd like to get a loan, rather than having to trawl through his accounts and his books and all that type of stuff. You say, well, you got any equity in your house? Great,
Yeah, that's
I'll
right.
have it.
Bank
Yep,
collateral.
done.
And that's cheap for the bank.
It is.
I mean, there's no cost in assessing the loan. So anyway, they can't really turn up commercial, no. But I mean, it's very obviously what the correct path is here. You cut interest rates to try and stabilise things a bit and get more credit into productive stuff, as well as stabilise prices a bit. And allow a little bit more spending and just ease up on what are very distinct and clear mortgage pressures right across the household sector. And if you see credit going in the wrong spot, then you tighten macroprudentially, right? I mean, this is what we did over the last 4 years to end the bubble in the first place. The RBA cut, and then they stupidly resisted macroprudential for years to manage the credit impulse that they created. Now you're just putting the cart before the horse if you're going to start doing stuff with APRA, ahead of RBA. It may be in the end that the RBA slashes and burns and ends up at zero interest rate policy, or our version of it, at maybe 50 basis points, and then the APRA still has to wind back. but you don't go APRA first. You go RBA first. But
and partly because we want the Aussie dollar down.
And you want the dollar down.
Yeah.
Exactly. And that's productive. That's productive investment that you're triggering, right?
Yeah. And when Dave says productive investment, because basically what happens, Aussie dollar falls. Companies then in Australia are more competitive versus foreigners. Yep. If companies, multinationals, are thinking about hiring somebody in Singapore or thinking about hiring somebody in Sydney, they're more likely to pick Sydney. It's just that whole, that's where our thesis is that's where the next drive has to come from. Yeah.
So I don't think that APRA will cut these buffers before the RBA cuts, but I really don't know. I mean, the whole money management process in Australia is busted.
Yep.
As you say, you're making as good a suggestion as anyone in turning a knob on commercial lending, and they might do it. Like, they might try, because all the rules are out the window. The RBA's busted its own mandate. APRA long ago broke out of its mandate. There's been no assessment of how the two are combining.
It's all secret.
It's all secret. Supposedly operating through the Council of Financial Regulators, but we could see 4 rate cuts and the decimation of lending standards in the next 12 months, for all I know, and the boom go nuts.
Yeah.
Right. I mean, or we could see APRA slash lending standards, the RBA do nothing, the dollar roar up. I mean, it's actually chaos
because it's all secret. We don't know what they're thinking. Whereas the RBNZ, I think Dave did an article a while back saying it's got about 400 people employed there or something. The RBNZ is both the central bank and the prudential regulator. It's always very transparent in what it does. It communicates to the market. You're never left in the dark about what it's thinking, and it acts. It acts timely. RBA's got over 1,000 staff. I think APRA's probably got about 700 or 800. And we never know what they're thinking. They always work across purposes. 2,000
staff versus 400 at the RBNZ.
Yeah.
The RBNZ's got capital targets on the banks there that are splendid.
Yep.
They rely on big dumb rules
that work.
They don't need staff creeping around in bank offices and doing handshake deals in boardrooms and whatever. They don't need all that staff.
Well, partly as well though, because none of the banks are local, because so you don't have as much of when all your banks are foreign banks, you don't have that whole, we can't let this bank fall over because that'll decimate the economy.
Maybe so, but
partly for them,
it's still a great working model.
Yeah, well, and we mustn't forget the UK's gone towards the New Zealand model as well. I mean, the UK separated the prudential regulator from the central bank. We had the GFC. They brought them back together because they realised it didn't work.
So I think what's going on with the campaign to gut lending standards at APRA is, as interest rates fall, the banks are going to see more net interest margin pressure. Even though they'll keep some of the hold some of the interest rate cuts back in their mortgage rates, I think they'll do that regardless of any political pressure. They're hitting the zero bound in what they can do with their deposit rates. Like, they can't cut them any lower, so they start to see net interest margin pressure. So they're going to struggle to grow profits, and in fact they may see profit shrinkage. And so this is why the banks have kind of enlisted the help of the AFR to try and resist further interest rate cuts and to use these APRA tools instead. That is my best guess. Now, we know how corrupt Australia is, especially banks and these captured regulators, so it's just an open question of, can they resist? Can APRA resist? I mean, I think even if they do, I don't think that they could turn the knob on the APRA lending standards fast enough for it to matter for house prices. Largely because
it's also a question about pushing on a string, though, as well, isn't it?
Yeah, it is. Yeah. And you don't get any public kick out of it. Like, there'll be no new bullish sentiment in the market from APRA turning the knob on obscure lending standards.
It's also probably a second order issue in a lot of ways, because the bigger issue is the inflation of the suppression of expenses through the use of the household expenditure measure, which is what all the banks did prior to the Royal Commission. So they basically banks relied on a poverty measure to assess people's expenditure rather than what they actually spend. And that's
this is the HEM.
Yes, the household expenditure, the HEM. And the ASIC's currently battling Westpac in court over effectively the HEM, and that should help determine whether it's going to be appropriate in the future.
The Royal Commission has already trashed it.
That's right, yeah. So I guess if we assume that the HEM never comes back in its previous form and banks have to do proper expense assessment, that's probably a more important drain on credit availability and future house prices than say dropping the interest rate buffer by from 7.25 to 6.5 or 6%.
Yep.
So I don't think it'll have as big an impact as some people think, provided the HEM is still outlawed.
So you're essentially using the banks as the arresting factor in mortgage growth.
Yeah, but I guess it comes back to saying, as you said, it makes a little bit of a difference if they cut it, because then people can borrow a little bit more. So the question is, though, probably more important is what David was alluding to, is saying this though is the start of something that sounds dangerous in terms of
where does the corruption end?
Yeah, 3 months. Are we in 3 months past the Royal Commission? Maybe 2 months past the Royal Commission, and they're already trying to, can you just loosen the rules up over here and change the rules a bit for me over there and all that type of stuff. It's sort of like saying, well, how can you possibly be doing that so quickly?
Yeah.
So that's a sign, as David, I sort of want to pull you back on something you said. If the RBA cuts 4 times and we loosen up all the credit standards and housing goes bananas, that's the question. That's the bit where I can see the first 2 happening. And whether 4 times or 3 times or whatever their limit is, maybe some quantitative easing. The question is, is that housing going bananas a necessary, an automatic, consequence of that happening? And that's where I'd sort of disagree with you and say, well, I don't think it is automatic. If you've got enough of a housing crash, then people will step back and say, and as we saw in Perth, that we still had all this stuff was happening in Perth. We still had all the loose lending standards, but that market was done, and people were stepping back and saying, well, housing, mining boom's finished, and we just saw house prices keep on sliding, and people didn't step in. And so that's where I'm coming from, is saying, well, if it's progressed far enough, and I think it probably has, and I think the fact that the RBA has waited so long, and obviously waiting a few more months, is that I do think we've passed that point where even if you do cut and loosen up, you won't necessarily, it might help stabilise things, but I don't think you'll see a new housing, it's not the new housing boom coming.
No, I think that's right. Like I don't think we'd see a boom either, in part because of the HEM as well, and then also. We've got the fiscal question. We're going to see negative gearing reform, and we don't know what shape that's going to take either. It looks like it's probably going to get watered down from Labor's ideal policy, but we really don't know.
I'm a lot more bearish on that than I was. Like, I thought it was almost a fait accompli to come in, and now assuming Labor wins, I don't even think it's a 50% success, but.
In its current form.
What do you think watering down?
Just because the Senate crossbench is very against it.
Centre Alliance.
It's already pretty watered down from a. So how would you water it down further?
Well, Centre Alliance has said that. So Centre Alliance seems like the only crossbenchers, apart from the Greens, if you want to call them crossbench. The Greens will back Labor. They'll need probably a few more numbers. They'll probably get it if they got Centre Alliance. And Centre Alliance seems to be more in favour of just capping the number of properties. So, for example, they might say, you can only negative gear 1 property or 2 properties, which isn't really going to cut the mustard. Like, they'll probably knock out, I don't know, maybe 25% of negative gearers. I'm hoping if they do go down that road, they should do what they're doing with the tax advice cap and just say you can negative gear a maximum of $3,000.
So actually quantify a figure rather than a property, so to speak.
I mean, look, obviously none of this is perfect, but if they do go down that road, I'd rather see them do that and get rid of the whole existing versus new exemption, whatever, just clean it up.
There is one other possible, well, I'm sure there are many permutations, but one thing, Centre Alliance has been running very, very hard on the franking credit stuff.
Can that.
And they really hate the franking credit stuff for some reason.
Yeah, they hate it more than negative gearing. That's
they do.
Sure.
They've been sort of pinning all their election advertising on franking credits, not negative gearing. Right. And there may be a deal to be done there where they can trade the two, and so Labor gets its property tax reforms through relatively intact, and does sort of trade off on franking credits in some way.
It'd smack a big hole in their budget plans, though.
Yeah,
Because
it would.
the franking credits about $5 billion a year.
Yeah, it's a lot.
But yeah, having said that, there's probably a deal to be done to say,
Yeah.
okay, well, let's cap it to, $10,000-$20,000 a year or whatever, which would
Yeah.
get you where you want it to be. Which
Yeah.
is you're not going to affect your more average investor, and you are going to hit the guys who are pulling in millions of dollars of franking credits.
Actually, that'd work well. That would work well.
So,
Well, there you go. New policy. From
So-
I hadn't even thought of that one.
should we maybe just give our views then on the most likely outcome at this
Yeah.
point? I mean, I'm happy to do that. I think basically the RBA will be forced to cut 4 times still, despite all of this hoopla and its resistance.
4.25s. So there
Yeah,
we
it
go.
has
Yep.
to be, yeah.
Yeah, 4 times 2.5 over the next 12 months.
So cash rate of 0.5%, which is
more or
basically what
less,
Canada
yeah.
got down to.
Yeah, and that'll be the bottom. And they'll preserve some for net interest margin for the banks. And, God knows.
Then we're into quantitative easing.
Yeah, and, maybe there's a bit of APRA thrown in along the way or just afterwards. I don't know. I think the HEM stuff is likely to come in as a kind of adjusted HEM, which is fine actually. Like if you adjust upwards expenses according to income, etc., that basically takes away the problem with the HEM, and it would keep lending standards still reasonably tight. Who knows who wins the court case, but I think that adjusted HEM is likely anyway. Labor gets through a reasonably substantial reform platform, and I think that ends up in some price stabilisation, no rebound,
A long grind.
and then but some stabilisation, enough to sort of slow the falls, make some of them more real than nominal, and critically as well. This depends on kind of Labor coming in and just spending its arse off to support the broader economy, thanks largely to 300 unfortunate Brazilians who have died in a mining accident that's just sent Australia's terms of trade to the moon. So, meaning that the government's going to have lots of money to spend for the next couple of years.
There is also another sleeper. Can I add just one other thing? Labor's, I won't go on too much about how bad the policy is, but Labor has basically said that it'll allow all migrants in Australia to bring in 2 elderly parents each, if it's elected, for periods of 10 years and then extendable for another 10 years, so effectively permanently. And there's a potential then that we could see a lot of, people sell up offshore, come into Australia and buy houses here, which will be illegal. So basically, for every skilled migrant we bring in, we could also get 2 parents to come with them, and all the money they've got.
And all the healthcare.
Yeah, that's it. It's
costs. So
it's
go
an
along healthcare.
abysmal policy, but especially when you care about so-called ageing population, you're going to age it. You buy 1, get 3. So anyway, but enough of that. But it is a sleeper for the housing market if it does go ahead, because you could see, we obviously saw the impact of foreign buyers over the last 5 years. Well, this could be foreign buyers on steroids.
Okay. Yep. Damo, you want to throw in some projections or estimations?
Yeah, I think I guess the way I look at it is more, I think we're headed down a dark path at the moment, and I think the RBA waiting means that there's more potential for quite a negative outcome and quite a negative downside. So I guess I tend to think of it in probabilities, and so I think without doing anything, I think the cases would be quite dire, and you see some of the real housing bears come out and talk about these destruction and value and how there's going to be blood in the streets, and you can say, well, on the path we're on at the moment, I can see that happening. Having said that, I think there's going to be a lot thrown at the housing market to try and hold it up, and I think especially if the Labor government gets in and has got the housing, the negative gearing and this money to throw at it. And so for me, it's about saying, well, how successful is that going to be? At the moment, I think it's going to be successful at stabilising it, but I still think there is some significant risk of downside. So, and I can't see the scenarios where the whole thing turns around and bounces back, and house prices sort of start going up. I do think that slow grind sideways is is possibly the best outcome we can be hoping for.
Yeah, sure.
I'll just add, like as you say, like the further into it, the more risk you take, and that like there is this, there's a sort of kernel of evil, if you like, at the heart of the Australian banks on housing lending, which is the way they risk adjust their capital for mortgages, and it's got this rehypothecation thing at the centre of it, which is when you're taking one set of collateral and pledging it multiple times, and it means that they've been able to heavily discount capital constantly, which has enabled them to multiply their lending over time on a small capital base. And there is a point somewhere, a tipping point, where the fall in collateral actually starts to reverse this, and they have to start gathering capital.
It's almost like a margin loan.
Yeah,
Yep.
and they have to start bringing in capital as their collateral implodes on itself.
Yep.
And this is the risk that all the authorities are taking, is that you reach that point and that the banks themselves become little time bombs that are unable to lend. They have to start pulling lending as they increase their capital. And so at that point, if you allow it to get to there, then you're in very serious trouble.
Yes.
And where that is, nobody knows.
No.
But is it,
Like,
but does that turn into a too big to fail, sort of put your hand up and get a handout
that
sort of
turns into
situation?
a massive accident and bailout.
Yeah. And we need to remember that the banks are only hold on average $2 of capital per $100 lent on a mortgage.
Yeah.
So they're very thinly capitalised.
Yeah, and so that's the another reason why I think the RBA is being bloody irresponsible in what it's doing. But that is like the core kind of risk for the big crash, the big short, etc. And it is just sitting there. And we get closer and closer every day while prices fall, and you just don't know exactly where that point is.
No, it's all secret.
And that's my point, is that don't discount. You see some people come out and talk about this is going to be down 40%. This will be bust, and you've got to have your money under your mattress and all that type of stuff. And I say, well, I think a lot of their reasoning is all based around this fact of this is a trajectory we're on. We're going to keep going, and we're just going to plow onto the ground. And saying, well, no, we do have the ability to lift the plane back up again, but if you hit stall speed and the engines die, then
You got no option.
Then there's a lot more. There's a lot more trouble. So, I guess I'm looking at the negative sides of it. I do think, in those negative cases, it isn't a matter of having gold or having your money buried in your backyard and things like that. I do think that the Australian government will step in and bail out banks if need be in those negative scenarios. We saw that happen in Ireland. It's probably the best analogy, where the Irish government effectively bailed out the German banks. And so I do think, given it's Australia bailing out Australian banks, I think there's certainly an analogy there.
Yep.
And Australia hasn't got that much debt, at a government level, so we can certainly step across.
But it undoubtedly comes with a much deeper house price bust. So
yes,
you end up down 40% almost in 30, 40 in nominal terms, not real over 10, but
yeah. So I think there's a bit of a bifurcation point where I still think the base case is right. What the guy's saying is we house prices keep falling for a little while, and various authorities throw everything they can at it, and we sort of stabilise, and hopefully, as you said, David, a lot of it gets done by the inflation rate. So if house prices can stay still and we get a bit of inflation, then you get some real house price falls. But the flip side is, don't discount there is that negative. A few non-linear events that could drive it much lower. So you need to be careful.
And that is part of the problem now. I mean, previous housing corrections, we've had high inflation. So back in the early 80s, there was one. In the 70s, we had one. But it was all on the real side. Because inflation was running so high, the prices didn't actually need to adjust. They just need to tread water for a few years.
And a lot of the time, wage growth would just inflate.
That's right. That's right. Yeah, because just back in the late 70s, we had the wage price index going up about 20%.
Yeah.
So your mortgage, it's a great time to be in debt. your mortgage would just your mortgage would get eroded away, and you'd basically inflate your way out of your debt. But now we've got minimal inflation, so it means all the adjustments got to happen to the headline price of homes.
Minimal wage growth,
but minimal inflation and an RBA that doesn't want to cut back despite minimal inflation.
Yeah.
That's right.
And a business press wants to lower the inflation target to 1%. That's so.
But it's going to be a lot more. It's going to be a lot more in your face. Adjustment on the nominal side when you actually see your prices fall is a lot harsher than through inflation. If your wages and everything's going up, and your prices are sustained, treating water.
And also the part of you can just hold your debt steady for a few years, then and your wages will go up, and eventually you'll be able to afford it a bit more. But when you haven't got that inflation and your debt starts to get out of control, and that's when people have to default.
Unfortunately, in Australia, a huge mortgage today is still a big mortgage in 10 years' time.
Yeah, well,
whereas back in the 70s, it was small mortgages, and then 10 years' time it was almost gone because of inflation.
Yep. Interesting. Just one final question, actually, or point prior to just jumping into the investment implications was: do you think that essentially Australia might find themselves between a rock and a hard place vis-a-vis population due to a lack of demand and the ability to just, as we know, turn on the old population demand tap when things become difficult? Do you see that as a rising issue?
Look, it's a fascinating question. I mean, we have very successfully destroyed the immigration narrative over the last couple of years.
As a nation, or
no, MB has, and really turned it on its head, where it was an almost unquestioned kind of benefit to now a kind of ongoing pain in the ass for everybody, slowly ratcheting up or slowly lowering your living standards. And I think really that debate is over. Like we won that debate comprehensively, but it's made no difference whatsoever.
Yeah, the politics are still the same. I mean, the three major parties they're all on a unity ticket, so it's hard to break the nexus.
Yeah. Can I be a little bit more specific with immigration, because I think there's a few different elements to it. One is when countries are going well, and take Australia for example, in the financial crisis, or just following the financial crisis, where our economy was recovering and most others were in the toilet. And that's sort of a big push. People in other developed countries would say, "Oh, okay, things are going well in Australia. Maybe I move to Australia and I find a job." And and you get that, you get the immigration that you'd call good immigration, which is people looking for opportunities and they're going to come here and they're going to work, and there is work for them to do, and there's all that type of stuff. There's another type of immigration which is we've just sold you a degree which is to people who can't speak a lot of English and possibly wouldn't have got, or the evidence seems to show that they wouldn't have got that degree without sort of if they weren't paying big dollars to be in the country, and if they're coming if they're coming to the country and then you say, okay, is that immigration adding or subtracting? And they're certainly adding to the congestion and things like that. They're not particularly productive while they're students still, and the question is if they shouldn't have got the degree, then they come out and they're driving an Uber or working at McDonald's. They're probably not really adding a lot to the whole economy. And then the third type is, as Leith said, if you bring in a lot of and senior people, and those people are adding to the house prices.
Yep.
So they're adding a lot to house prices, but not adding much to productivity of the nation, because they're just here studying.
Also adding to public services, demand, etc.
And then you have the saying, well, let's bring in a lot of old people, especially a lot of old rich people. You say, well, now we're just in the same boat again, where we've got house prices going up, but unproductive, except for the fact that these people need healthcare. So there'll be lots of jobs for us emptying bed pans and doing that type of stuff. And so the question for me is partly how big is the immigration, but more importantly, what type of immigration is it?
And also how it's dispersed. Obviously, if it's all coming to Sydney and Melbourne, which has been the case, is not ideal.
Yeah, sure.
Yeah.
And so just quickly going back on that senior immigration potential policy, are they sort of mandated to carry things like private health insurance?
Yeah, so
interesting.
Yeah, so they will have to have private health insurance, but as we know, the private health insurance basically relies on having a whole bunch of healthy young people that don't use the system subsidising older people who do use the system. So we don't have risk-based pricing here.
Yeah, sure.
So basically I pay the same as my mum does, even though she's 70. And I haven't been a doctor in 5 years. So obviously, if you bring over, hundreds, they think straight away we're going to 100,000. But if you bring in hundreds of thousands over time of elderly people who are going to be using big users of private health insurance, that's going to push up everyone's premiums.
Yep.
You're going to lead to a flight of young people leaving the systems. It's too expensive, and then you get the death spiral, which you're already seeing. On top of that, obviously, it puts up demand for hospital beds, etc. We need to train more doctors. We need to invest more in hospitals. Doctors, nurses, etc. Part of their training is paid for by taxpayers. There's a lot of public subsidies. Then you got obviously high demand on public transport, everything, all other infrastructure type services which are paid for to a large extent by taxpayers. So it's not a very good policy. That's all I can say.
Okay, yeah, sure. Quick roundup on investment implications. Sounds like we've covered a little bit in depth.
Yeah. So it all comes back to that, needing protection. Like if your only assets are a house in Australia with a big mortgage on it, maybe an investment property, some Aussie banks sitting in your portfolio, plus a bunch of Aussie shares that are all leveraged to the Australian market, then you need some diversification.
Okay.
Bonds are. We've seen most of the gains in the bonds. There's probably a bit more to go. We're still overweight.
Yep.
Nowhere near as far overweight as we were before. But there's still an element. We still think there's a good chance to outperform, especially if we see the rate cut scenarios.
So that's a bit of buy and rumour, sell on news sort of thing. So once the RBA starts cutting sort of in earnest, bonds are still going to be on the investment palette. Do you think?
They will. But what you typically see is markets will start pricing some recovery in inflation, so you get curves steepening.
Yep.
So the front end of the bond curve falls much more than the back end, and the back end is where we are, and it's where the gains are.
Yeah, sure.
And so you get diminishing returns out of the trade.
Yeah. So if you own let's say you own a bond paying 2% per annum for the next 1.5% per annum for the next 2 years, and then interest rates get cut down to 50 basis points overnight, you'll pick up a couple of percent. Yeah, right. But that's it. And that's only if you sell straight away. You've got to sell that 2-year bond straight away. Whereas if you're in the 10, 15-year bonds, you get a much bigger uplift in those. But we've already seen most of those gains, and we're sort of running at bond rates of sort of whatever tenor you are, but you're sort of 1.7, 1.8 percent, and inflation's 1.3, but inflation should be over 2. So you're basically over a 10-year period, you're looking at a negative real return. But the question is, maybe a negative real return might be a good outcome. And there's also the chance to trade it. That's the option to say, well, as things get worse, that asset will actually go up in value, and then I can use that to go and buy other assets that have come down in value. So those, and then looking to get your money offshore where possible and reasonable. There's certainly lots of issues bouncing around and trade wars, and you do need to be quite selective about what you're buying at the moment. But we just still think there's a decent amount of opportunities internationally as well for your money.
Okay, fantastic.
Plus, the Aussie dollar should still fall as the RBA is forced to cut. I mean, we've been toying with a higher dollar in the short term as China stimulates, but this negative yield spread thing that to the US is very heavy headwind for the Aussie. And the bulk commodities boom that we've got going will diminish despite China's stimulus, just because the supply side will respond over time.
Okay. Yeah.
So you'll get more dirt from more places.
Okay, very good. All right. Well, look, thanks, gentlemen, for a very full podcast today. So we've covered off on one of Australia's favourite topics, and also thanks to everybody who contributed on our live chat as well. There's lots of comments and I think rhetorical questions. I apologise if I didn't get to anything that was a real question, but we'll jump into next week. So next week we are looking at Trade War 3.0. I think we're up to 3.0, but anyway, perennial subject, and I think it will be as long as Mr. Trump's in power. But so that's same bat time, same bat channel, 16th of May at 12:30 Australian Eastern Standard Time, and we'll see you there. Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return we'll send you a weekly email with new webinar topics, links for our podcasts and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you with the next one. Cheers.